Okay, so in this video, I'm going to talk a little bit about how the initial investment is computed as it relates to a capital budgeting project. So basically, to start with, one of the things you're going to need to look at is the overall cost to get the asset ready for use. And that's going to be our depreciable basis. And this is going to include basically everything that has to be spent on this equipment or asset in order to get it ready and available for use. So that would include the base cost, so the initial purchase price or cost, whatever that is, any shipping or handling costs, any installation costs, any modification costs, basically everything that's spent on that asset specifically to get that asset completely set up and ready for use and installed and so forth. So that's going to be sort of our overall depreciable basis. We're going to have to factor in all those costs associated with the purchase of this equipment at time zero. Now, sometimes purchasing a piece of equipment or machinery or some other kind of large asset can actually trigger a required change in net working capital. So net working capital is current assets minus current liabilities. So let's use current assets as our example. So let's suppose that for some reason, installing this new machinery requires an increase in the level of current assets that I have to keep on hand. Maybe it's some kind of inventories or something like that. So if I have to keep more on hand and current assets are going to go up, so if current assets are going up as a result of this installation of this new equipment, then what that means is I'm going to have to spend money to buy those current assets. And so the thought there is if my net working capital figure overall has to rise due to the equipment, that's an outflow of money that I'm basically dedicating now to current assets. So I'm having to allocate more resources to current assets, and that would be an outflow. So an increase in net working capital is an outflow. A decrease in net working capital is an inflow. So if you see an increase in net working capital, think expenditure. If you think a decrease in net working capital, think inflow. All right. Now, if this happens to be a replacement project where you had a piece of equipment and you are replacing it with a new piece of equipment, in that case, then one of the things that's going to happen at that time zero when estimating cash flows for capital budgeting is we're going to have to sell that old asset. So if I sell that old asset, we need to factor in salvage value. So I'm going to take the salvage value, what I'm going to sell that old asset for. But then what I need to do is I need to actually figure out, did I make money or lose money on the sale? So in order to do that, what you're going to do is you're going to find basically the accounting book value of that particular asset that was being sold. And you're going to compare what we sold it for compared to what that accounting book value was. So if the old asset was sold for $10,000, the accounting book value was $7,000. We realized the gain of $3,000 on the sale of that old equipment. Now, if we realize the gain, that means we're going to have to pay taxes on the gain. So we need to figure out how much we're going to pay in taxes. Once we've figured out how much we're paying in taxes, that means the cash flow from the sale of that old fixed asset is going to be, in my example at least, the $10,000 that we sold it for in the salvage, and then I have to factor in the taxes I'm paying on the gain. So it's going to be 10,000 minus whatever those taxes were on the gain in order to get to the overall cash flow from the sale of the old fixed asset. On the other hand, what if we had a situation in which we sold it for $10,000, but the book value was 15? So if I sold it for 10,000, the book value was 15, then actually I have a loss on the sale of the asset. Now, this is where there's an interesting little point that needs to be discussed, comes in. And that is, if we assume that the company is making money elsewhere in its business, which is probably broadly true in most cases, then if that's the case, I have realized a loss on the sale of this equipment, right? It was sold for 10,000, but the book value is 15. I've gotten a loss on the sale of this equipment. And if I have a loss, then if I had been making money elsewhere in my business, I was about to send the government taxes on those profits elsewhere in the business. But then along comes this $5,000 loss, which is going to reduce my taxable income, which is going to reduce the amount of money I need to send to the government in taxes. And there's a saying, and that is a penny saved is a penny earned. So if I have essentially saved a certain amount of taxes due to this loss, I need to account for that due to this equipment, due to this purchase choice. So what I would do in that case is show that, all right, we sold it for 10,000, book value was 15, we had a loss of 5, and then I would apply the tax percentage to that $5,000 loss and show the result as an increase in inflow, basically show that basically we're assuming we're making money somewhere else out in the business. And because of that, that assumption, this loss came along and it actually reduced what I was going to send in taxes. So I get essentially a little bit of a tax benefit here. Now, a few little notes of clarification here. First off, that doesn't really necessarily mean that the government is actually giving me money. Really, what it means is I was about to send the government money elsewhere on profits that I had elsewhere in the business. But because of this loss, I don't send the government as much. And so it's saving me money, and it's incremental cash flow, therefore. So it doesn't mean the government necessarily is actually sending me a check in this case. It really kind of just could possibly be just a situation where I don't send the government as much money as I was about to. Also, it's worth noting that this tax benefit on the loss, this doesn't actually make me happy about having a loss. At the end of the day, I still sold an asset for less than the value it was on the books for, right? And the tax benefit I get when I had that loss does not make up for the fact that I sold it for less than what it was on the books for. So it doesn't somehow make me happy. It just means that I'm less sad, if you will, right? So it's sort of a silver lining to the clouds that I sold the asset for less than it was on the books for, all right? So ultimately, at time zero, basically what you're going to have is that total cost to get the asset ready for use. Any changes in net working capital, we need to reflect that. And if it's a replacement project, we need to account for the sale of that old equipment and look at that salvage value, look at what the tax impact is, put salvage and tax impact together to figure out what's the ultimate cash flow associated with the sale of that old asset. And that's how you would calculate that year zero cash flow or your initial investment in this capital budgeting kind of analysis. Hopefully this video has been helpful. Thank you so much for watching and have a great day.